Hello, mic test 1 2 3. Test test test. Okay. Hello, very good morning to all. Welcome to today's daily dose of market insights. I'm Kelvin here again. Very good morning. Today will be Thursday, the 10th of October 2024. So before we start our daily dose for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So I hope that just give me 1 second just to make sure that everything is good. Yeah, good. I think the sound is good. Yeah. So as usual, before we jump straight into the short-term intraday technical outlook on the various broad-based cross-asset classes, let's have a recap what has taken shape yesterday in terms of the performance of these respective broad-based cross-asset classes, and is there any related news flow that is very important that we should take note of that could actually impact these cross asset classes going forward? All right, so let's start with the news flow and event that has taken shape yesterday first. So yesterday's new important news flow is related to the the release of the FOMC meeting. So in the FOMC meeting, that was this, okay, put in a way that this meeting give us a very detailed breakdown of the discussion among the US Federal Reserve officials before they officially announce their interest rate decision on FOMC day. Okay, so this minute was actually was a recording of the discussion on the previous month, September mega jumbo cut of 50 basis point. So in the minutes, actually, they actually show there was a robust debate about the size of the September rate cut, and some officials would prefer the quarter point cut instead. So what we could see over here is that, put in a way that given this round of so-called findings in the discussion among the US Federal Reserve officials, given that some of them are favoring for only a 25 basis point cut, rather a mega jumbo cut of 50 basis point, going forward, there is lesser and lesser potential chance that we may start to see another round of 50 basis point cut even the next 6 months down the road. Why? Because the US Federal Reserve officials, they have this stance on very data dependent, taking things one step at a time, and given the latest data right now that is showing, especially the very strong non-farm payroll data that came in way above expectation, and based on the minutes, there's a finding that the primary concern in the Federal Reserve official mind right now is rising risk to employment. That means what they're afraid that the US labor market has starts to turn soft. And given the fact that the labor market hasn't really turned soft, with that very strong NFP print that was released on last Friday, yes, there's a huge debate that it could be an outlier. But given this strong push up over here, there is much more hesitant by the US Federal Reserve officials to enact another 50 basis point cut in November or December. So that is actually being priced right now into the CME Fed Watch 2. So you look at the CME Fed Watch 2 over here. Oops, sorry, let me open again. CME Fed Watch 2. Yeah, so this CME Fed Watch 2, for those who are first time seeing this, is in fact based on a calculation of the latest market pricing, the tradable price, the pricing on this liquid tradable 30 days Fed funds futures contract, and from there we are able to actually gauge the odds of the next FOMC meeting based on the current pricing. What will be the likelihood of the magnitude of the US Federal Reserve cut or hike in terms of the Fed funds rate? So if you look at this table over here, current, okay, so the current one is pointing towards the next FOMC meeting, which is on the 7th of November. So on the 7th of November, the current rate right now is 4.75% dash 5%. So in US is rather unique. The Fed funds rate is not a single digit, but it's a range, 4.75% to 5%. So right now, market is expecting a high chance of 81% that the Fed will only move by 25 basis point cut. So how do we know that? 81% centered that after the 7th of November meeting, the Fed funds rate will be reduced to 4.5% to 4.75%. So you get this number minus of this number that's implied a 25 basis point cut. And only 90% chance have a view that the Fed will move by a bigger cut of 50 basis point to bring it down. No, sorry, not 50, but 0% chance will have 0% chance that the market is expecting the Fed to bring it down to 50 basis point, but there's an increasing chance right now. Previously, last week was I think less than 1% or so. Now there's 90% chance that the Fed may stand pat. That means they may not cut at all during the next meeting in 7th November. So how do we see that, right? We can see a change over here. So this is the current rate. So previously 1 week ago was 0%, okay, 0%. And right now, due to the release of the latest related information pertaining to the Fed funds rate interest rate decision, which is the release of the Fed funds futures, the Fed funds minutes yesterday, it increases the odds of a stampede, but still not too big. It's less than 30%. But right now, previously there was 35% chance. Last week, looking for a 50 basis point cut, another mega jumbo cut, but that has been greatly reduced to 0. Okay, then how do we see the pricing down the road? That means November, December, January, February, March, April, means 11 months ahead, is by looking at this one called aggregated, the aggregator tab. Okay, so under the aggregator tab, let me expand it so that you guys could see. So what you could see over here is that currently it's at 4.75% to 5%, and you move down the line over here. So 7th of November meeting, 81% chance it will bring down to 25 basis point to 4.5%. So December also market is looking at high chance of only a 25 basis point cut, 87% chance now to bring down to 4.25%. So if you move down the calendar across next year, 20th of January, 19th of March, right? Every step move downwards of the Fed funds rate to reduce, it will be reduced by only an incremental of 25 basis point. And after the 29th of January 2025, the Fed may not do anything on the 19th of March 2025 meeting. Why? Because there's a high odds right now. It will remain the same at 58% chance to remain the same at 4%. So net overall, right, what you could see over here is that there could be 1 cut, 2 cut, 3 cut, 4 cut, only 4 cuts, 7th of May 2025 to bring it down to 3.75%. Then after that, another cut, 5th cut, 18th of June 2025 FOMC meeting. This one a slightly higher chance at 53%, but almost on par with stamp of the next one at 46% now, to bring it down lower to 3.5%. Then thereafter, right, in the 30th of July, the 17th of September, 29th of October 2025 FOMC meeting, the odds will be highly centered at the 3.5%. So it will start to stampede on 30th of July next year, pardon me, 17th of September next year, and 29th October next year. That means, i.e., by the time it comes to next year, the Fed funds rate will only be reduced to 3.5%. So that is a slightly lower magnitude 2 months ago. Also 2 months ago, market is expecting the Fed to actually cut as low as, to bring the Fed funds rate to as low as 3%. So given the fact that the amount of so-called jumbo rate cuts has been reduced, and even going forward, it doesn't starts to have a firm confirmation that every meeting there will be a 25 basis point cut until next year, under 12 months from now, obviously, i.e. 12 months from now. So there's a risk that from 7th of May onwards next year, the Fed will start to stampede, okay, in the next 1, 2, 3, 4 meetings starting from June 2025. So that actually reduce the risk, the risk of further dollar weakness, and we start to see the dollar strengthening in the last 2 weeks. And yesterday the dollar continues to strengthen again. If you were to look at this chart over here, okay, this dollar index, okay, this is the US dollar. So the US dollar index, right, continues to strengthen for 8 consecutive sessions, so that's about 2 weeks. So yesterday it rallied, has a daily close, okay, as a daily close above the upper limit of our medium-term pivotal resistance level at 102.70, 102.70 over here. It broke out. So right now, what we could see over here is that the entire trend of this US dollar index on the daily time frame chart over here, ever since the low of 13th of July 2023, so that's about 1.5 years ago, something about that, 1 year and 4 months ago, it has been trapped in this complex sideways range configuration. And the current low almost hit the lowest point of this sideways range configuration before staging that bounce. So overall, what we could see at this point in time, there is a higher odds right now, instead of coming down lower to retest this low at 99.60, it may now starts to hover more towards the upper limit of the range at 105.50, 106.37, this upper limit of this complex range over here. But definitely it will not go one vertical line all the way. I mean, it will start to oscillate, but for it to come back down and break below whatever the low of 1st of October to test the 99.57 level, the odds seems to be lesser right now, given the daily close above the 102.70 medium-term pivotal support. That means, i.e., what we stress over here is, yes, on an intraday basis, that means from a daily basis, I mean from every day on an intraday basis, on a very short-term time frame, we may see a bit of dollar weakness coming back into the picture. I mean, there could be still some form of dollar weakness, but on a bigger time frame, that means we're talking about this is a daily chart. That means stretching from a multi-week to even multi-month going forward, the movement of the dollar index seems to be pushing up higher, stronger, unless there is actually very strong reversal of US growth related leading indicator, like for example ISM services PMI starts to turn down, the non-farm payroll data for next month. That means we got to monitor in the first week of November, right after US election, that October print starts to revise or turn downwards after that very strong print that was released on last Friday. Then that could potentially see the dollar index reversing downwards. All right, so this is the related data I'll share with you all accordingly. That is impact on the FX market. And how does it impact the US major stock indices? So given the fact that the Fed itself, the Fed seems to be still on the path of cutting interest rates. That means there could be a further release of interest liquidity into the US financial system. And given that growth right now is either tilting towards a no landing or soft landing, but very low odds of a hard landing, that actually lead to the US major stock indices continues to rally for the second consecutive day in a row. So all the major US stock indices rallied. The SPX up 0.71%, the Nasdaq up 0.8%, the Dow Jones Industrial Average outperformed by 1% over here. So the reason why the Dow Jones outperformed because it's considered as a lagging index, one of the lagging index together with the Russell 2000, that if we continue to start to see an improve in US economic growth in terms of the odds, and as well as the Fed is still on the mode of cutting interest rate rather than standing pat or even think about hiking back again, it could actually be positive for these largest major US stock indices, because initially everyone is being hyping on the AI related team play that is centered have that their component stocks are heavily weighted in the Nasdaq 100 and the SPX 500. Now the positioning will start to shift down towards the laggard, which has a lower valuation. But the Russell 2000 yesterday disappointed by 0.26%. So if we look at the heat map of the S&P 500 over here, what we could see is almost across the board is in the green. So one thing I want to highlight over here is very interestingly is Google. So Google actually underperformed yesterday by negative 1.6% among the mega cap technology stocks, and also underperforming was Nvidia, almost also down slightly, negative 0.18%. So what's interesting about Google over here is more related to firm specific, but different specific event it may impact Apple. Okay, one highlight over here is Google at Bloomberg. Okay, so there's this law that's being passed. Okay, so right now, right, there's this law that's being passed, right, due to this antitrust law that Google app itself got to actually be more liberal in opening up its ecosystem to third-party apps, and also allow anyone who actually whatever app that is being installed inside Google Play, the user of the app will be allowed to pay that developer directly. That means the fee revenue sharing of Google and the app developer will be reduced. All right. So they actually the one of the US court actually passed this so-called judgment over here. So that actually caused this negative feedback loop into Google or Alphabet shares over here. Share price over here down negative 59%. And also there's actually a particular so-called suggestion that Google may break out as well. Google breakout. Bloomberg. Okay. Yes. So right now there is some of the legal courts hanging out. So I try to, okay, so basically hopefully it comes out. So basically what I'm trying to say over here is that there is a risk right now in one of a firm specific risk that is taking shape in Alphabet, which is a major mega cap US tech stocks. And this mega cap US tech stocks over here has a high weightage on the SPX and the Nasdaq 100. So potentially it could have a negative spillover impact on the share price movement of these two major US indices, SPX and Nasdaq, especially Nasdaq, there's a higher weightage on Google. And we know that Google app has a similar business model with Apple. All right. Okay, Apple, okay, which managed to gain yesterday at 1.67%. So Apple has also a app store, as you all know. So app store Apple is also one of a significant revenue generator as well for the group, the entire Apple group revenue on top of iPhone sales. So let's say if the US legal circle managed to be very successful to pass this antitrust so-called law to actually prevent Google Pay or the Google App Store to have an absolute monopoly to control how their revenue fee that the app developer got to pay to Google, it may starts to look at Apple. I mean, after the successful legal case on Google, they may start to target Apple, and we know that Apple is the biggest weighted market cap inside the S&P 500 and the Nasdaq 100. So something to think about in the longer term perspective. Short term intraday perspective, yes, the momentum of the Nasdaq 100 is there. Later I'll share with you all during the intraday technical outlook. But on the longer term basis over here is that if this scenario starts to happen, we got to ask ourselves that perhaps the Nasdaq 100 to uh, expose pandemic outperformance against the major US stock indices and against the rest of the world, that may temper off due to this potential negative spillover impact from this antitrust firm-based specific risk that is right now surrounding Google. And Google business model has a very similar model, App Store model with Apple. All right, something I want to share with you all. Okay, so these are the news flow and event that has taken shape yesterday over here. Okay, now the next key thing I want to share with you all is on a fundamental and a intermarket dynamic. So that one will take a longer term period to form. All right, so let's start with the fundamental first. So we know that fundamental, we can actually look at this one kind of a leading US economic indicator. So we know that there's a lot of indicator around in the world. So in Citigroup over here, so this is I get it from micro okay, a bit of tongue twisting, macro micro website. So this is a database that stores a lot of excellent fundamental based data that we can use to access in relation with financial market, but that is more of a longer term perspective. Okay, so this chart over here, right, this little okay, let me okay, yeah, so this blue line over here is the US Citigroup Economic Surprise Index. So what this doesn't mean over here is that it's actually done by Citigroup, and micro managed to pull the data from Citigroup over here, and this data over here is not live. It's the latest based on 7th of July, so that's 3 days ago. So 3 days ago, also taking account of non-farm payroll data. So all the very important related economic data, this will be compiled inside the Citigroup Economic Surprise Index for US. And basically what this index mean over here is that they actually take the difference, is the sum of the difference between the actual, okay, between the actual value of the various economic data and their consensus forecast. So that means, i.e., if this index is going upwards, that means that there are more US economic data that is managed to surpass expectation, which is generally good in terms of the US economy. And what we could see over here is that previously, any number that's okay, zero, right? So ever since May this year, May this year, there's actually a so-called hard landing scare or recession scare, where the Citigroup Economic Surprise Index for US continues to inch downwards to zero. But only recently, up to August, it starts to inch upwards. And as of first week of yeah, what is it? Yeah, 1st of October. From 1st of October onward, this index starts to actually reverse back above zero in positive territory. So meaning that once it goes above zero, there are actually more US key economic growth data that are beating expectation versus not beating expectation, which is actually tell us right now there is a higher odds that the US economy right now is either in the soft landing or the non-landing scenario that actually supports this ongoing bullishness that is being depicted in the major US stock indices since the start of this week or even late last week after the release of that US non-farm payroll data. So some of the very important this particular index we can actually monitor. So right now it continues to see a series of higher high and higher low, right? Unless it's deep down back to below zero again, then that soft landing or hard landing scenario in the US economy starts to reduce. So you guys can actually, I mean, just go take a look at this macro micro website. They have a trial period. You can sign up. A trial period is free. Some of the data, even though it's not on trial period, is available free to public as well. Because to me, I sign up for their. I'm a paid subscriber to them, so you can actually take a look at it. I mean, there is a ton of very interesting data, macro data that we can actually construct from that. So what we could take a look at over here is now pertaining more to a multi-week perspective. This is for multi-month long term. More of a multi-week perspective is by taking into account of the relationship with the VIX, the VIX index and the MOVE index over here. Okay, so this line over here, okay, maybe I don't know where is the, okay, let me see, hopefully I can get something out. Okay, the thing is disappeared, okay, never mind. So let's go back to weekly again. Okay, so basically, right, this little pink line here is the MOVE index. So this is the implied volatility on US Treasury notes and bonds. All right, US Treasury notes and bonds, and this line over here in, okay, maybe I just put it in writing now so that you guys can have a better move. Okay. Okay, then this one is VIX. Okay, this VIX. Okay, so what we could see over here, right, since 19th of August, okay, the price has started to shape a series of higher low, higher low. Okay, higher low. So market participants now, right, especially on the VIX, so how do you see the VIX go up, right? Is people start building hedges in their equity portfolio. So to prevent any so-called tail risk event taking shape, especially we know that there is a US election coming, which is less than a month away, could be a big surprises. So market participants wants to build protection in their portfolio, they will build up VIX. Okay, they'll buy VIX related product and build up the price of VIX. So the price of VIX also starts to increase over here. That means every time there's a dip, there will be always a higher low, but it can't break out to the upside. Since this 22nd of July, so 29th of July high, 3rd of September high, still see a set of lower high. It still can't break out, but every time it hit on the bottom, there will be people bidding up the VIX price, building up portfolio protection ahead of the key risk event, which is the US presidential election. And what's interesting over here is that the MOVE index, which is the implied volatility for US Treasury bonds and notes, the price, not the yield, the price of the US Treasury bond and notes, also start to build up as well. And they managed to break out over here. That means they start to shape a higher high. It broke out. And this broke out over here, right? What you could see very interestingly is that means market participant right now expecting the prices of the US Treasury notes and the US Treasury bonds to actually fall much further. So that could also imply that the 10-year US Treasury yield or even the longer term 10-year yield, like the 30-year, may starts to remains at a higher level for a longer for a period of time going forward. Then do not forget over here is that the Fed itself has starts to reduce the possibility of mega 50 basis point cut. And based on that, that Fed funds rates over here, the Fed funds futures as implied by the CME Fed Watch 2, the Fed last cut will be on 18th of June next year. Then thereafter, they will start to stampede. All right. So that potentially, right, we'll start to see the 10-year US Treasury yield remain at a higher level. So that actually explains to us why the MOVE index starts to break out. Okay, it starts to shape that bullish breakout to higher high. And what's interesting, right, how does it impact the market over here is this this is the S&P 500. Okay, this one is the S&P 500. Okay, S&P 500. So this chart here, I plot the move of VIX divided by move. That means it's the relative strength of VIX divided by move. That means if this line is sloping upwards, that means the VIX right now has a higher relative movement compared to the move index, the implied volatility on the US Treasury notes and bonds. So what we could see over here previously, right, there is this decline. Okay, this was during the so-called the subprime crisis. The VIX and the MOVE ratio also sloped upwards over here. Then thereafter, this was during the inflation scare in the global economy due to higher oil prices from from late December 2021. The market actually tumbled over here from a multi-month perspective. The VIX and the MOVE ratio also sloped upwards. And right now, it has been sloping upwards since 11th of December, flashing a warning sign on the S&P 500 as well. Okay, a warning sign over here. So what it means that over here is that yes, the S&P may continue to churn up, but there is a indication of cautious that implied volatility of VIX may starts to rise at a faster rate compared to the MOVE index by indication of this VIX divided by the MOVE ratio over here. That means there is some form of market protection that is being brought right now ahead of the risk event of the US presidential election. Do someone know something? I mean, people will talk about conspiracy theory, right? But forget about whatever conspiracy theory, but I just look at the movement of this ratio. Is indicating to us from a longer term perspective, we got to be a bit cautious in terms of building up this what they call a very long bullish position in the US stock market, especially centered on the S&P 500 and the Nasdaq 100. Okay, so this is the fundamental and intermarket dynamics I want to share with you all for today. Okay, now let us now straight away jump right into the short-term intraday technical outlook on the major cross asset classes. So before that, let me expand my screen first. All right, so starting with the FX market. Okay, so on the FX market over here, before we jump straight into the intraday technical outlook, let's have a quick look at the 5-day rolling performance of the US dollar against the other major currency as of now we are speaking. So what you could see over here is that in fact, the dollar strength, right, has also starts to like go sideways, temper off so far, temper off. So yesterday, dollar strength was the most pronounced against the Kiwi dollar, and right now, as we are speaking, the strength also starts to actually mean revert as well. You could see the dollar Kiwi now doing a bit of give back of yesterday's strong gain as well, and that been also reflected on the dollar Aussie as well. So because the Kiwi and the Aussie tends to have a very strange inter-direct correlated movement even on the longer term, medium term, even on short term basis as well. So with the strength of the dollar tempering off against the Kiwi, we start to see a bit of tempering off in today's Asia session. In fact, it really started in late US session yesterday against the Kiwi as well. And yesterday there was a strong push up on the dollar yen, but right now we start to see the dollar yen, the dollar strength against the yen starts to temper off as well, and very boring movement against the euro and the sterling yesterday. Not much movement. In fact, the dollar Swiss and the dollar CAD as well. Okay, so now with that, let us now jump straight into the short-term intraday technical outlook on the euro dollar. So mindful, this is a very short-term intraday movement lasting for at least 1 to 2 days only. All right. So like I said earlier on, the broad-based dollar index seems to be indicating multi-week to multi-month dollar strength, but we know that price action don't go vertical up, they actually oscillate, okay, within a trend. So that means there's also a chance that the euro dollar, after sliding from 120, 112 figure level in the last 3 weeks or so, may starts to shape this mean reversion rebound. So yesterday we do highlight this key pivotal support level at 1.0940. Price action managed to hold at this level, and what we could see over here is that we see the RSI starts to inch up higher at this juncture. And if you could do a very short breakout, so there's a bullish breakout right now on the RSI. Okay, there's a bullish breakout on the RSI over here, so indicating that there could be a chance of a minor bounce taking shape into the euro dollar, at least on the intraday basis for today. All right, at least. All right, so with that, we will still maintain that intraday bullish bias on the euro dollar using 1.094 as my short-term pivotal support level. First near-term resistance level to watch out for on the intraday basis, again, I want to stress for today, will be this level over here. Okay, 1.0970. So a break above 1.0970, then it may expose the next near-term resistance level at the 110 figure level. But however, if price action can't go up and break down below 1.0940 with an hourly close below it, then this intraday bullish bias will be invalidated to see the continuation of the impulsive down move of the euro dollar to test the medium-term pivotal support at 1.0890, which is the correspond to the very closely to the 200-day moving average as well. Okay, that's for the euro dollar. Now, turning our attention will be the sterling dollar. So the sterling dollar continues to hover around the 50-day moving average, traded almost sideways yesterday on the 1.070 short-term pivotal support level that we highlighted 2 days ago. But very interestingly, the RSI continues to print this higher low. Okay, higher low over here. So still no change. Still looking for this still maintaining that short-term intraday bullish bias because it hasn't broke below clearly the support level at 130.70. So using 130.70 short-term pivotal support on the sterling dollar, still maintaining its intraday bullish bias. First resistance to watch out for today will be at 131.30. Unless it can clear above 131.30, then we may see a much more pronounced short-term mean reversion rebound scenario taking shape or unfolding to expose the next near-term resistance level at 131.60 next. However, if price action starts to break down below 130.70 on the hourly close below it, then we may see the extension of this corrective decline sequence to expose 130.40 and even 130 figure, which is our medium-term pivotal support level. Okay, so that's for the sterling dollar. Turning our attention will be in Asia right now, will be on the Aussie dollar. So the Aussie dollar also continues to actually hover at the 67.20 short-term pivotal support level, playing around with the 50-day moving average as well. And what we could see over here is that the RSI has managed to actually shape a higher low again. And if you could draw a parallel descending resistance over here, okay, which correspond to this previous high of 27th of September where it hit, then thereafter where it shaped the bearish divergence, then it did that minor corrective decline, and this trend line resistance has now started to shape a bullish breakout in today's Asia session, indicating that this particular decline or minor decline from the late September all the way down to yesterday's minor swing low, the downside momentum has indeed eased off by this positive findings that has now taken shape on the hourly RSI momentum indicator. So with that, still no change. 67.20 short-term pivotal support level, still maintaining that intraday bullish bias for that minor mean, at least a short-term tactical mean reversion rebound scenario unfolding. First resistance level to watch for sure, no change, will be 67.70. That was almost about to be test on yesterday's late Asia session before it came down and trade lower during the European session and the US session. So a clearance above 67.70 will increase the odds of a further rebound scenario unfolding to retest 68.10, which is also the 20-day moving average, I think, as the next near-term resistance level as well. However, with a breakdown below 67.20, that would invalidate today's intraday bullish bias to see the extension of this minor corrective decline sequence to expose the next near-term support level at 66.70, followed by 66.35, which correspond to the key long-term 200-day moving average. Okay, now turning our attention will be the dollar yen. So the dollar yen is now playing at this 49.30 medium-term pivotal resistance that we highlighted yesterday. What's interesting over here is that the hourly RSI has this bearish divergence. Okay, shaped this bearish divergence, higher high in price action, but lower high on the hourly RSI. So with that, right, given that it didn't break that 149.30 medium-term pivotal resistance level, we will still have that bearish bias. But this bearish bias conviction will only increase if price action break down very quickly below 148.13 level. This line here, 148.13. So it got to very quickly break down this 148.13 to increase the odds of this bearish bias to at least retest 147.20 on the intraday basis. Okay, so these are the two key support level to watch out for today on this dollar yen. But however, if instead of coming down, the price starts to push up above 149.30, then this intraday bearish bias will be invalidated because to respect this very strong persistence rebound movement on the dollar yen. Next resistance level to watch out for will be 150.20, followed by 150.90, which are our major resistance level, which correspond to the key long-term 200-day moving average as well. So that sum up the intraday technical outlook on the major US dollar pair. Now, turning our focus will be on the major stock indices over here, starting with the Hong Kong 33. So the Hong Kong 33 yesterday returned neutral because there is no clear signs of a bearish further movement because it come very close to the pivotal support of it. In fact, this is not a short-term pivot, it's a medium-term pivot. Okay, it's a medium-term pivotal support, MT. Okay, the 20-day moving average as well. So it come very close to the 20-day moving average, 1979/445 over here. So now with that, what we could see interestingly is that the RSI has shaped that bullish divergence as well. So with this bullish divergence that's being flashed out on the hourly RSI, it seems to us that expose lackluster or disappointing NDRC breathing sell off, the downside momentum has started to lose its pace or has started to ease off. We will now flip back to intraday bullish bias for sure, using 19,790/19,445 as my pivotal support for today. Breakout above 21,550 exposes 22,300 2220. If we start to see a much more pronounced break above 22,320, then we will start to see on-site the next resistance at 23,550 slash 23,670 Fibo extension resistance, Fibo extension cluster level 1.618 from the low of 11 of September and 3.618 from the low of 6 of August. Graphically, over here is this congestion area over here. We go back in time. Oops, is this area? I got to go to the daily time frame. Okay, is this area here. Okay, this level, yeah, this one, this former what called bounce support break turns into a pullback resistance. Okay, this area here. Okay, so now unless we start to see the price action starts to break down, oops. Okay, and on the hourly time frame, right? This just like the hourly time frame, this is the daily time frame. On the day time frame, it start to shape this bullish hammer candlestick as well. Okay, now going back to the hourly time frame, unless price action starts to break down below 19,445, then this intraday bullish bias or recovery will be invalidated on the Hong Kong 23, i.e. the Hang Seng Index, to see the continuation of this corrective decline sequence to expose the next near-term support level or next support level, i.e. at 18,230, which correspond to the rising 50-day moving average. Okay. Now, Japan 225 is a bit unique, or the K225 is a bit unique, because still recall yesterday we did highlight that since its high of 27th of September this year, it has been trapped in this symmetrical triangle range configuration. And yesterday it hit the upper limit of the symmetrical triangle range configuration, can't break, and now shape a bearish reversal from it. And very likely it may start to actually revert back to the lower limit of this symmetrical triangle range configuration over here. You see this line over here. So still no change. 39,790 is indeed a very, very key short-term pivotal resistance level to maintain our intraday bearish bias within this minor symmetrical triangle range configuration that is still in play in the Japan 225, i.e. the K225. Near-term support to watch out for still remains unchanged. The levels 38,740 followed by 38,260, which is the lower limit of this minor symmetrical triangle range configuration, which is the IE, the minor symmetrical triangle range support, and so confluence closely with the 200-day moving average and the 20-day moving average, coming to as a similar support level as well at 38,260, pardon me, 38,260. But however, if suddenly price can't go down and starts to revert up and break above 39,790 with an hourly close above it, then this intraday bearish bias will be invalidated. This is where potentially we start to see the bullish breakout of this symmetrical triangle range configuration. Next resistance to look out for 40,155/280, followed by 40,800/990. Next on the Japan 225 or Nikkei 225. Now, turning our attention will be the German DAX. Okay, so the German DAX or German 30, yesterday we do have a bearish bias below this short-term pivotal resistance at 19,220. It's looking for it at least a retest down to 18,960, which is this level here. But however, unfortunately, yesterday it only printed a low of 19,020 level. Can't test the 18,960. Then thereafter it came out and shaped a bullish break during the start of the US session. I would say it's about 11, okay, 2 hours later from the start of the US session. That's 11 a.m. Singapore time, before the close of the German DAX. It break out above the short-term pivotal resistance, so invalidating our short-term bearish bias for it to at least retest the 18,960 level. So from here, what you could see on the German 30 over here, it seems to us that they actually start to shape this new impulsive up move over here. But given that the hourly RSI has really reached the overbought level and there's a hint, but there's no bearish divergence, so only a chance of a minor pullback. So this minor pullback level, first resistance level to watch will be this breakout point here at 19,220, then followed by 19,130, which is this minor range resistance, now turns into a pullback support. And this 19,130 will be my short-term pivotal support for today to flip to a intraday bullish bias. Next resistance look out for will be the current all-time high area, 19,460/19,550. Then thereafter will be 19,690/19,755, which is the Fibo extension cluster level, 0.236 from the low of 10th of September and 0.764 from the low of 5th of August. Okay, so that's the next resistance zone to watch out for after this all-time high area is being breached on the upside. So however, if price action starts to break down below 18,000, break down below the hourly close below 19,130, bearish buyers will be invalidated. That means we will start to see another round of choppy movement again, back to retest the 18,960 level, a breakdown below 18,960 level, unleash or trigger in first step, a minor corrective decline scenario first to expose the next near-term support level at 18,690 next. Okay, so that's for the German 30. Turning our attention will be the major US stock indices. So we got to respect the US Wall Street 30 price movement. Yesterday, we were neutral between this 14,440 and 41,950. So yesterday, it did a bullish. It did a bullish breakout. Pardon me, a bit of tongue twisting. It did a bullish breakout above the upper limit of the neutrality range that we highlighted. Then with that, we got to flip into a bullish bias. But given that the RSI is at the extreme overbought level, okay, so this high here, whatever high, is much more higher than the previous high that we see. So there is a chance of a minor pullback taking shape, no bearish divergence. So minor pullback, first support level to watch will be at 42,440, followed by 42,180. So this 42,180 will be my short-term pivotal support that I have today. Flip to a intraday bullish bias on the US Wall Street 30 above 42,730, the current all-time high area. Current all-time high, I would say, will stage a further push up towards the 43,170 level, which is the one-time Fibo extension, taking into account of the low of 5th of August. Only a hourly close below 41,180 will invalidate today's intraday bullish bias. That means yesterday is a failure bullish breakout to see another round of choppy corrective decline sequence unfolding, exposing the next support level at 41,950. Only a breakdown below 41,950 may see an extension of this corrective decline sequence to expose the next near-term support level at 41,535, which is the minor swing low at 18th of September and 19th of September. So that's for the US Wall Street 30. Nasdaq 100 next. So Nasdaq 100 yesterday shaped a bullish breakout above our short-term pivotal resistance level 20,155 and shaped a higher high over here. So RSI also at the overbought level, where you could see potentially we may start to see at least a minor pullback. So first pullback level to watch out for will be 20,155. Then 20,000 will be my short-term pivotal support level, which is correspond to the rising 20-day moving average as well. So as long as this pullback didn't surpass below 20,000, flip to an intraday bullish bias. Next resistance to watch out for after 20,360 will be at 20,615, which is this minor swing high area of 15th of July this year. However, if price action starts to break down below 20,000, then yesterday bullish breakout above the 20,155 is considered a failure bullish breakout, and right again you'll see another round of messy, choppy, corrective move on the Nasdaq 100 to revisit the next support zone at 19,750/19,630 next. Okay, so that sum up the intraday technical outlook of all of the major stock indices. Okay, so now let us turn our attention to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, it continues to hover below the 20-day moving average at this 2,624 level. Okay, 2,624 level. So with that, right, since it managed to stay clear below the 20-day moving average for the entire session yesterday, I would tighten my key short-term pivotal resistance level for today. Okay, this level here. Okay, this minor swing low, minor swing low, minor swing low, break now turns to pullback resistance, very close to the 20-day moving average at 2625. So this will be 2630. Okay, 20. In fact, it's 2632. Okay, 32. Okay. So as long as this 2632, 2632 short-term pivotal resistance holds, a tighter one slightly on the downside, 2632 short-term pivotal resistance holds, the gold XAU/USD may continues to evolve in this minor corrective decline sequence within its medium-term uptrend phase, because price action is still trading above the 50-day moving average. Near-term support level to watch out for 2,590, followed by 2,570 level at least on an intraday basis. However, if price action starts to pierce up and cleared above the 2,632 level, then this minor corrective decline scenario will be invalidated. That means it start to trade above the 20-day moving average. That means that will be the resurgence of that bullish momentum coming back into Gold XAU/USD again. Near-term resistance level to watch on the upside will be at this 2,674/2,684, the current all-time high area over here. Okay, that's for Gold XAU/USD. All right, so lastly will be the West Texas crude oil. So West Texas crude oil, yesterday we showed a bit of weakness, but managed to actually form this bullish hammer candlestick after a retest at the 50-day and the 20-day moving average, which is the 73.15 level. All right, 73.15 level. So in fact, this is in green over here. So with that, no change, we still maintain our intraday bullish bias over here at 73.15 level. Okay, so give it a bit of 73.15 level. So as long as this 73.15 level holds at this point in time, we will still maintain the intraday bullish bias on West Texas crude oil. Near-term resistance level to watch 75.70. In first step, above it may see a retest on 78.30, which is the minor swing high of 8th of August over here. Okay, 78.30. Only a breakdown below 73.15, then this intraday bullish bias will be invalidated to see a revisit of 71.47 followed by 71.10 next near-term support level. Okay, so that's for WTI crude oil, and also sum up the intraday technical outlook on the major cross asset classes. So before we go, let's have a quick look at the calendar on what are the key data to look out for today. So for today, let me put it this week. So that, sorry, I'm talking about. Okay, this week. Okay, so today will be Wednesday. Oh, pardon me, today will be Thursday. Okay, so for Thursday over here, during the European session, we have German data, which is out at 2 p.m. Singapore time, and we do have a RBA official speaking during the European session, 3:45 p.m. Singapore time, RBA Hunter speech, and IMF World Economic. IMF will release its latest World Economic Outlook at 4 p.m. Singapore time, but that shouldn't be a big surprise. The major key economic event to look out for will be the US core inflation rate, all right, or the US inflation data out at 8:30 p.m., 1 hour before the start of the US session. Market is still expecting a continue of a deceleration of core inflation in US. Similar rate of August, market is looking at 3.2% year on year. So there's a big risk, right? If this level come in way above expectation at 3.4 to 3.5%, then that could potentially see a further push up in the US dollar, and that will bring out the resurgence of so-called inflationary pressure or even stagflation pressure back into the US economy again, and the Fed official may be hesitant to actually keep on cutting interest rate next year as well. So there's something to look out for, 8:30 p.m. Singapore time, and thereafter will be a rather quiet session. Okay, no key official speaking thereafter. All right, so with that sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great and wonderful day ahead, and we shall speak again tomorrow. Thank you.